What is good, everybody, and welcome to episode 4 of the mentorship. In this episode, we are capping off the first section of the mentorship, and I'm capping it off with a model. Now, I've given you the 234 model that's available in the Discord, and today I want to give you a weekly candle model. So, let me readjust real quick. You guys know I trade one candle, I focus on one candle's expansion for everything. So one candle gives me expansion, as I've explained. The narrative behind that one candle allows it to expand. So today I want to give you guys a one candle model for the weekly candle and how we engage with that. Okay, so what are we looking for? Well, of course, we start on the weekly time frame and we're looking for one candle to expand. So we are predicting the very next candle. This is what I taught you guys in episode 1, I think, if I'm not mistaken. We are only trying to predict the very next candle, and it's always that way. So if you take a look, now I wasn't bearish here. I'm gonna be straight up honest. I wasn't bearish. I was neutral. So I wasn't bullish. I wasn't bearish on dollar, right? Because little gem, you are looking at the dollar and you are trading EUGU. So you're pushing buttons on EUGU, but really you're looking at the dollar. Okay, I wasn't necessarily bullish here, but GBP USD went down because Euro GBP went up, and I'll get into that in a separate video. That's a separate video into market analysis. I actually want to note that down. So let me write down into market analysis because that's very important. We'll do that in another section, but yeah, I need to before I forget that. Now, GBP USD went higher because dollar went lower. I mean, dollar went higher. I've got it completely mixed up. Excuse me. Pound USD went lower because Euro GBP went higher, right? So meaning Euro is stronger than the pound. So if one of them is going to go down, pound is going to go down with much more momentum. So this, in hindsight, is obviously a predictable candle, right? How do we engage with this candle now? And I've said before, stop runs and continuation purges, previous session purges, things like that, right? But if we're not trading a daily candles expansion where you would usually look for previous session raids, if we're not trading that and we are instead trading a weekly candles expansion, what are we looking for? What key high are we looking for? Because you're not just going to go in and short, right? As smart money traders and as expansion upper class students, you guys obviously are not just going to go into the market short. You are way too good for that. You are way too advanced for that. So, where do we actually position ourselves? Well, the obvious answer is always above old highs. But which old highs? In a weekly candles expansion, previous day highs. Now, you may notice on pound USD, we did not take any previous day high. But what about dollar? Okay, what about dollar here? And we'll look at the day when dollar took previous day low, right? So if we go to dollar, because remember I told you guys, dollar is what we are looking at. Dollar is what we are analyzing. You're just trading EU or GU. So really you're trading the dollar, but obviously we don't trade DXY itself. You trade it against euro and pound, right? So if we go into dollar, the weekly candle, we're looking for bullish expansion here, because on pound we're looking for bearishness. Dollar, we're looking for bullish expansion in hindsight. How do we get involved in the market? Well, previous day low. So when does the weekly candle open? Here, right? Let me remove this. And obviously buy side, a consolidation rests there. You've got premium arrays, what I taught you, remember, the last 20 days, right? So if we take it from there, last 20 days, where are the premium arrays? Here, here, right? So you mark up them. And then what are you waiting for within this weekly candle? This is the weekly candle from this line to this line. What are we looking for? We are looking for a previous day low ran because that's a key low, ideally into a key level. Now, I'm not sure if this did tap here, but that would be our key level. Okay, we mitigated it on this side, and then we ran previous day low on Thursday, right? So now, previous day low gets ran within that weekly candle's expansion, right? Remember, this is for the weekly candle. Previous day low ran. You are also looking for a 4-hour swing low. So, previous day low ran or a 4-hour swing low. Ideally, a 4-hour swing low as well. That's the main teaching I want to get into for the weekly candles expansion. A 4-hour continuation purge. Because, guys, the whole mentorship, I've taught you about the narrative so far. I've taught you about everything else. But what I really want to hone in is when you've predicted the candle to expand, when you've done that, now all you are looking for is continuation purges to get in line with the market. And that's what you're looking for. Everything else I teach you, like intermarket analysis, everything I teach you about that is secondary to expansions and how to get in line with expansions. Because without knowing that, you're not going to take any trades and you're not going to get in any markets. So how do we get involved? This for your notes now. How do we get involved with a weekly candles expansion? 4-hour continuation purges. And usually a 4-hour continuation purge will result in a previous day low or high being ran. So again, this is a delineation of our weekly candle. Look, key low ran into what? Into a random level? No, into a key level. What I've been teaching you this whole time, guys. Okay, it's the same framework. And this could be a 15-minute candle. This is what I'm going to teach in that section 3, or section 4. It depends how many more things I add in the meantime, because things keep popping up into my head that I need to teach about. Again, I said this was a deep dive into what I used to trade. So in whatever section it may be, I'm giving you a scalping model. Scalping model meaning we're working within an hour of trading, about an hour and a half really, and you can take trades on a 1 minute. Why? Because the 15-minute candles inside that hour are set to expand. So again, what did I tell you? How do we engage with an expansion candle? Continuation purges. The same things, but you can fractalize the idea. Why? Because it is what the market runs on. If everyone out here tells you the market runs on liquidity, how do we engage with it? That's all you need to be asking. And I've figured that out and I've given it to you guys here. Anyway, enough rambling. Weekly candle, delineation, stop run into a key level. It never changes. It's that same thing. But remember what I taught you about changing the states of deliveries. And these, again, have to emphasize, these are not cherry-picked examples, right? When do we actually change the state in delivery in this market here? Right there. As soon as this candle closes above that price level there, we have changed the state in delivery. Why? Because these are the candles that brought momentum and dug into a key level. Back here, there's a weekly gap, right? Or a weekly down close candle, whichever one it may be. Big weekly down close candle that got traded into. You may expect a retracement. So you have your key level, you have a stop run into the key level. Remember the pattern I taught everyone, right? Consolidation, range low taken, back here, external range liquidity engaged, change the state in delivery. These same market paradigms appear over and over again. So whilst we get the 4-hour stop run on Tuesday during London even, whilst we get that, we also changed the state in delivery at the start of the week. So we are now bullish. You are now confirmed bullish. So you get a stop run, rally higher, OTE throughout the week, fair value gap, rally into close. And really, it is as simple as that, guys. Now, I'm just thinking where I want to take this teaching next, right? There's a few things I could say for another episode, and I probably want to say for another episode. But I kind of want to make this one a bit short and snappy because I really want to hone in on the idea that all you need to engage with an expansion candle is a continuation purge. And it usually ends up in a previous day low purge on the weekly time frame. If you're looking for a monthly candle expansion, what are you looking for? Here, right? Take a look at this. Take a look at June's monthly candle, right? June there. dive down. So what does that look like on the daily? Swing high. Okay, guys, I want to leave it there. I'm going to dive into deeper stuff, but in different episodes. But I think this one I need to keep short and snappy because I want you guys to really take in what I've just given you here, to engage with an expansion candle, because remember, I told you at the start, this is all we're ever trying to do. To engage with that, what are you looking for? You're looking for swing lows or highs to be taken, i.e. continuation purchase. That is how we engage with expansion candles. And how would we engage with a 15-minute expansion candle? Okay, how would we engage with this over here? Let me show you. Right, you guys take guesses. Okay, how do we engage with this? Okay, there was literally no previous swing low ran. But how would you engage with this 15-minute candle? Even here, right, it's the same thing. And take a look at the times here. That'll be interesting for NASDAQ. But look at the swing low here. We have the consolidation I talk about, the range low, right? Range low taken. Then any continuation purge. Unfortunately, we didn't get one here. Any continuation purge within these is a long. And by the way, guys, if you don't get that, you don't trade, right? I get questions all the time. How do I engage with the candle if I never get my criteria in that candle, in that example? You don't. You miss the trade and you sit on your hands and be patient. This is how I've ended up making a living, more than a living, off of charts. Because I'm able to wait and be patient for my criteria that I'm literally giving away to you guys. I'm giving you guys the criteria I use to make money consistently in these markets. Every single one of my students, okay, who listens and applies these things in the past, makes money in these markets. Literally, I think a few days ago, as I'm recording this, now you guys will see this a lot later, towards the end of the month. As I'm recording this, 2 days ago, one of my students just got a 5-figure withdrawal and maxed out Top Step and got 300k funded by My Funded Futures. Using these concepts and this strategy, the idea that one candle is set for expansion, and then how do you engage with that candle? Simple, right? So I want to leave you guys with that. Take it in, take notes. Now, I know this is a shorter video. There will be a lot longer videos than this one in the mentorship, but it's important you get this one and you write down what I've just said in this one particularly, because it's the framework behind catching an expansion. And then what do you do? Also note down, what do you do when that framework behind catching an expansion move doesn't appear? You do nothing. Okay, and that is how you stay in this game. That is how you stay in this game for a long time, right? Hope you enjoyed. I'll catch you guys in the next one.
What is up, everyone, and welcome to episode 2 of the mentorship. I want to talk about in this episode IPDA data ranges, and specifically how that relates to the quarters and the months. So what are IPDA data ranges? These are data ranges that algorithm will refer to for key premium and discount levels. And how do we use them? Well, at the start of every quarter, you want to count back. So July is a quarter, January, April and October, right? You count back from the candle that July the 1st was printed. Count back 60 days from there. Okay, hold on. If I can do this correctly. Count back 60 days from there. So you would go on to press shift. Okay, let's do it here. So that's 1. Count back 60 days. 60 is there. Okay, so on the 7th of April, 60 days. From the quarterly open, count back 60 days, and you can do 40 and you can do 20. These are, between these, the highs and lows between these are key highs and lows. Why? Because it is a data collection. So the algorithm refers to these highs and lows and the premium and discount arrays within these areas. If you take a look here, that is 60 days from the start of this quarter. 60 days back. The key high, the main high, and the main low here are the all-time highs there and the lows down here. All you are trying to do is determine which one are we more likely to go for. That is one way to use IPDA data ranges, meaning this is your long-term target or this, depending on if you are bullish or bearish. right? Very simple. Bullish is, we're obviously bullish on gold, so this would be my long-term target. Now, if I remove that, that is one way we use IPDA data ranges. My favorite personal way, because I'm an intraday trader, my personal favorite way to use IPDA data ranges is the 20-day look back. The 20-day look back from the day before you are looking to trade. So for example, let me give you again a real-time example. If today's candle, like I mentioned in episode 1, closes inside this range and gives bullish rejection on the lower time frame, I would be looking for this candle, Tuesday and Wednesday, to be expansion candles. So if I am predicting, again, it comes back to what? Predicting the next candle. If I am trying to predict the next candle, and let's say it does close inside here, and we get that lower time frame confirmation that I mentioned in episode 1, then I'll be looking for Tuesday. Let's say it does in this hypothetical, and I'm looking to trade Tuesday bullish. We count back from Monday. If we are trading Tuesday, you count back 20 bars, okay, on your screen. Press shift and do that. You count back 20, or just count back 20 candles, okay? So 1, 2, 3, 4, 5, 6, and literally go through and count 20. Okay, now you have this range from here, okay, to here, this data range. The algorithm on an intraday basis will refer to this range. More specifically, premium and discount arrays within this range. Those are what it's referring to. Now you have a macro scale, but you guys must understand that it's something excuse me, something I really want to preach in this mentorship is you guys have to understand that the macro scale is for the weekly, the monthly. You can forget about that, and you can literally be an intraday trader. As long as you follow order flow and the correct IPDA data ranges, you will be an intraday trader, and a successful one at that. So, last 20 days. Take the highest high and the lowest low within that last 20 days. This is for intraday price moves. So for example, what would that mean? If you were taking an entry on the hourly or the 15-minute time frame, for example, you would look at this. The highest high and the lowest low within the last 20 days, the day before you're looking to trade, is here. Okay, so you take premium and discount of that range. If you are looking to long, you want to be looking for longs in a discount of that 20-day range. Very simple, but it is so effective. If you now pair that with this range low being taken, pair that with this stop run here, continuation purge, into what? Mean threshold of that order block there. If you then pair all those things together, you get a market that is high probability for intraday trades. This is literally exactly how I trade. Okay, and this is why it's so important I talk about IPDA data ranges, because it's what I use all the time. When you see me taking hourly entries, 15-minute entries, 5-minute entries, I am using the IPDA data range, the 20-day look back. Okay, so continuation purge here happens. Again, we're assuming we get this close back inside here and the hourly displacement above this gap, close above it up here. Now, Tuesday and Wednesday are easy buys. Why? Because of that discount. Because we're in that discount of the last 20 days. Take a look at what happens here. We reject the high here into this inverse for value gap in a premium of the last 20 days. So let's say you're trading this candle. You count back 20 days from the previous candle, and now the highest high and the lowest low in that 20 days. Again, this is still this, right? We take the high out into a key premium level, being what? This inverse for value gap, and then we expand. We have print an inside candle because it was the 4th of July bank holiday, then we expand. So you use this IPDA data range to your advantage, and you use it to find intraday trades. Now, I'm going to teach something that I've never taught before, but this is another secret behind the 20-day IPDA range and how we use it. As you know by now, we have that range, right? Very simple. If you're bullish on the daily time frame, which we are, again, we've been bullish momentum, clearly. If you're bullish and we're in a 20-day discount, and you have a continuation purge into a key level. You are setting a stage for clean distribution. Okay, so rewind that and write it down, guys. Okay, really write that down. If we're in a discount of the last 20 days, now reverse everything I'm saying for sales, premium last 20 days, vice versa. If you're in a discount of the last 20 days, we trade into a higher time frame key level with a continuation purge. What is a continuation purge? A swing low means a low with a higher low to the left of it and a higher low to the right of it. If we take out that low into a key level, not a random level, not the middle of nowhere, a key level, which is the mean threshold of this order block here, then you set the stage for distribution when we show rejection on the lower time frame. After that, now you have everything you need to trade the hourly time frame, to trade the 15-minute time frame. But what you're waiting for is the right days to catch expansion. That is it. That is the whole goal of this mentorship. It's why I told you at the very first episode, you need to be able to predict the direction of that weekly candle. The next 5 weekly candles? No, the very next weekly candle. This is how I make money in this game, so please listen. Continuation purge. Discount the last 20 days. Key level. If you now get rejection, the key rejection you want to see, which is what? The rejection you want to see, the confirmation you want to see is this. That is it. Okay? That is the rejection you want to see. A change in the state of delivery and SMT. If you get that now on the lower time frame, you are having the easiest trading days will follow. It is as simple as that. That is my whole model. Now, the course is not just 2 episodes long. Okay, so obviously there are a lot more intricacies. But if you are to take anything away from this, let it be these last 2 episodes. Because the IPDA data ranges are key. They really are key. You use them on an intraday basis. This is how you use them in that sense. To frame intraday trades using this. And like I said, I like using gold here because I want to give real-time examples. Again, if we start to trade up here, then I'm looking at longs to these highs. And hopefully we get that. But if we close bearish here, then we're probably likely to see this rejection block. But here is another gem notes that you need to know, okay? The problem with everyone publicly and what no one teaches is that everyone's worried about every single array, every single low, every single high. We are not worried about that. You should be worried about the discount arrays, the premium arrays, and liquidity in the last 20 trading days. Not last 20 days, last 20 candles, okay? Candles that actually printed. That's what you're worried about, guys. That's what you should be worried about. Because you need to mark up this premium and discount, mark up every key array that price could draw to. Okay, let's do that. Let's literally do that now, right? You have this high, okay? This high is a key array. Now, arrays are also old lows and old highs. Okay, simple as that. Old lows and old highs. You have that high there. You have this low here. You have mean threshold of this order block. What premium arrays do we have? We have this high here. We also have this last stop close candle, which is an order block. Okay, I'll make my order blocks orange, just so they stand out. Okay, those are your key premium arrays. So what? The extremity of the range here. The extremity of the range here is a key premium array. Okay, the order block here is a key premium array. The swing high here is a key premium array, because arrays are old highs and old lows, order blocks, breakers, fair value gaps. And then you get propulsion blocks and all that. You don't need to be worried about that, okay? You don't need to worry about that. Just refer to them as order blocks, okay? Those are your key premium arrays. So those are where price, if you were bullish, could draw up to. Mark up all them. Now, you don't need to keep all these lines on your chart. These are in my head. I've been doing this for however long now, okay? When I'm looking at a chart, I'm seeing all these. I'm seeing where price could draw to. But you need to be aware of all the premium arrays, if you are bullish, that price could draw up to. You also need to be aware of all the discount arrays that price could reject from if you are bullish. What do you do if you're bearish? Mark up the 20-day range. Let me delete all this. Let's pretend we were bearish on this. You mark up all the premium arrays in your head that price could potentially reject from because you're bearish. You don't want to see price go up. If you're seeing price go up, you want it to go up to collect orders to distribute them lower. So you mark up the arrays you could possibly see decline from. What could that be? Well, let's say we were bearish on this market. In the last 20 days, this high, because it's in a premium, this up close candle, right? Because as price develops, this is going to stretch out here, and this is going to get lower, right? Also, but that's a different topic. This high, order block here, mean threshold is about in premium, okay? So above this high, you also have this order block. If we got up to there, we could potentially see some rejection from there if we were bearish, of course. And then also the weekly time frame, things like previous week highs. Previous week highs are key levels as well because they're old highs and old lows, like I mentioned. So if you were bearish, you would be looking for a key premium array to hold in the last 20 days for intraday trades, meaning entries on the 1 hour, entries on the 15-minute. I rarely go lower than a 15-minute. Now I'll go on to the 5-minute, but the 15-minute is all you guys need, especially if you're not yet profitable. Which, let's be real, if you paid me to be in here, you are not yet profitable. Or you may be profitable, you may be just profitable, but you want to make it to a new level. You should be trading the 15-minute time frame. It truly is all you need. Now, I'm going to teach a specific model at the very end of the course for NASDAQ that will give you absolutely everything you need to trade the 15-minute time frame. You can turn it into a scalping model if you are confident and start to see results with it, but you can do it on the 15-minute and the 5-minute time frame. That is a very specific model that I've developed just for you guys. But IPDA data ranges, this is an episode on that, so let me stay on topic. You'll see me do this quite often. IPDA data ranges. The key premium arrays, if you were bearish, are here. So what would confirm this high holding instead of getting up here to the mean threshold? What would confirm this high being the key order pairing high we use to distribute price lower? What would confirm that? Displacement. The list I gave you earlier in the video, which is what? Change in state of delivery, SMT, range high to low, and if I'm missing something, I don't think I'm, well, displacement in general, but you know, that's CISD. These things here confirm to you that price above here wants to go lower. And that is how we use the 20-day IPDA data range. That's the key. You mark up all the discount arrays, all the premium arrays. For example, again, just to recap, and I know I'm sort of repeating myself now, but it's so important. You have the range. Since I'm bullish on this market, that low is a key discount array. That's a key discount array because it's in the last 20 days, evidently, because these are the last 20 days, right? It's in the last 20 days. It's also paired up with, here's another bit of source, a range low. Why is this a range low? Well, because drop time frame and it's a range low. If we drop time frame even further, it looks like it even more. Okay, so the orders are being paired down here with the highs up here. I will teach that more in depth soon. But ignoring that, ignoring what I taught there, is also mean threshold of this order block. Remember. So now what do we have? Well, we have a bias. I'm bullish. Again, I want to see that weekly candle expand higher. It's Monday. We're likely creating the Judas swing for the week. We've traded below a discount low in the last 20 days. So we have a continuation purge into a key level. Mean threshold of this down close candle. Does it matter that this is mean threshold? No. It could be the opening price of it. It just happens that it's down here. Then you want to see displacement. And that is exactly how you use IPDA data ranges. So are you focused on random levels? No, you're focused on, at least on intraday level, the last 20 days. And when we're trading Wednesday's candle, you move it one this way. Very simple. But it's exactly how we focus on key premium and discount arrays. You also, guys, before I leave it, the key premium arrays we marked up in the hypothetical scenario where I was bearish, those key premium arrays, they are targets. That's where you take profits. So this high, remember I said this is a key premium rate. Why? It's in a premium of the last 20-day range. That's not hard to understand. A 6-year-old could get that. But it's a target. You take some profits above here and here. Why? Well, because it lines up with this down up close candle before the move down, so it's an order block. And it's also an old high, so it's a key premium rate in the last 20 days. And that's exactly how you use IPDA data ranges. I hope you found it useful, and I'll catch you guys in episode 3.